Welcome to the Aul Financial Hour Podcast with Steve Aul.
All right, we know it's in now, the big, beautiful bill. Trump recently signed it in. So what does it mean? Well, the tax proposal within it basically just means that all the key elements, from 2017 that were set to expire at the end of this year, it just means that they are now law. So all the lower tax brackets Americans have enjoyed, over the past couple of years, they're going to remain the same. So my question to you, Steve, is doesn't this kind of loosen up the whole planning for after-tax Roth conversions?
Well, the one thing that I will state on that, most of the things in that bill are law because it was done it wasn't passed by 60% of Congress. So most of the things are extended. So we'll just put it that way. It makes the tax system much more difficult. Okay? Extending the Trump tax cuts, I think, was the biggest thing that they wanted to do. But it's not been made completely permanent because of the deal. It's by budget reconciliation because they didn't get 60 members of Congress to vote for it. So we have a little change that way. But a lot of those, those promises during the campaign, that we're going, Social Security is not going to be taxed. That's not a true statement. That's a completely different law. But there is a part of this bill that says if you're over 65, you'll get an extra deduction to help reduce the effect of the taxes on your Social Security. Tips, that first $25,000 of tips is all dependent upon income also, as well as the $12,500 for overtime. If your income's high, or if you and your spouse's income is higher, it brings it back down. So it's complex. Mm-hmm. Is about the easiest way for me to put it. The people that I wouldn't want to be right now is TurboTax. I wouldn't want to try to figure out what's going in, what's going out, because of the fact. Remember back when the 2020 bill was passed and they cut it from a stretch IRA down to a 10-year.
Oh, yeah.
It only took them 4 years to tell us what they meant by that. I'm praying that it doesn't take that long for all of these, because most of them will sunset in 2028. Mm-hmm. So there's a lot of complications around it. But Roth conversions has made it more sense. And that's what we like to say. If you got too much money in IRAs and 401ks, Roth conversions could be the best thing that you could do. And when I say too much money, what do I mean? The average amount in a 401k is somewhere between $150,000 to $180,000. Well, if you've got an extra large, $250,000 to $750,000, you might spend those assets down during your lifetime, depending on the number of children that you have, on how that would affect their taxes. Then if you've got a double X between $750,000 and about $1.5 million, chances are you're not going to spend all that down. You're going to pass that tax time bomb on to your children, and they're going to have to get it out in 10 years, depending on whether you've taken your RMD or not, as in how it's got to come out. And if you have a triple X, if you've got 1.75 or 1.5 or more, you're probably going to pass a tax time bomb on to your kids. And I think by reducing or eliminating taxes is the best thing that you can possibly do for a successful retirement.
We talked about it before here. The group of stocks known as the Magnificent Seven, they're comprised of the big tech companies out there like Apple, Microsoft, Amazon, Tesla, you name it. And right now, they currently make up for more than 34% of the value in the S&P 500. But investment manager Joe Freed tells Morningstar that he's skeptical of the Mag 7's momentum.
We're talking about 7 stocks with a combined market value of greater than $10 trillion and revenues approaching $2 trillion. At some point, the law of large numbers kicks in. We think the market assumes that this group of companies will grow revenues at a compound annual rate of at least 10% over the next 5 years. This would imply the 7 stocks increasing revenue by about $1 trillion in 5 years. That's an extremely high bar in our opinion.
All right. So, Steve, where do you stand on this?
Well, I think your exposure to different parts of the market is going to be based on you. Everybody out there is different. That's why when I hear people talk about target date funds in their 401ks, there's no questions. It doesn't ask how risky you are. Do you have any other assets? What's your age? Do you have a pension? It doesn't ask any of those questions. It just says when you're going to retire. And I think it came into being because it was a simple decision to make. I'm going to retire in 2035. I'll put my money in a 2035 retirement date fund. Well, that's when we come to our side of the fence, and we got that availability. Once you're 59 and a half, money can move from your 401k, your 403bs in most cases, to an IRA. And then we have the availability to look at different types of portfolios. Stacy and Larry came in, 66 years old. Larry's still going to work till he's 72 to 74. Stacy's called it quits. About $1.2 million in invested assets. Mm-hmm. Not that far off, maybe more, a little bit less than you are. What do we do with somebody like that? Well, I believe that you should get the best return that you could possibly get with the least amount of risk possible. Because you can get a bigger return and take a whole lot of risk for it. And then the cost inside of them are also very important. We use ETF-based portfolios. Why? They're less expensive. If you're going to track that Mag 7 in the S&P 500, it's a lot cheaper to do it in an ETF than a mutual fund. It's just that way. Our individual stock portfolios. You're buying individual stocks, so there is no internal cost for those. So that's what we start to look at. What do you need? Where's your risk at? Are you an 8 or a 9 on that scale of 1 to 10? If you are, we could look at individual stock portfolios. What if you could look at, I'm not recommending it, some people want interest in blockchain, Bitcoins and things of that type of a nature. So people have that. Emerging technology. What's going to be hot 5 to 10 years from now? Now, I will state those are a lot more volatile. They're going to go up. They're going to go down. We don't put your whole portfolio in something like that. We take small pieces so that we look at it and say maybe 5 to 10% of my money could go into something like that, that it is more aggressive. And then I want that base or that foundation, especially if I'm going to be pulling income out of it, to be in the middle. I don't want it to go up, down, high, low. IRA accounts, going to be more steady when you hit your mid-70s. Why? Required minimum distributions are going to kick in. You're going to have to pull money out of that thing. Roth IRA accounts, I believe that they could be more aggressive for some investors if you have the stomach for it. Because a lot of people do. And we don't want to put everything basically under the rug and we'll pull it out when we need it once we retire. Because a lot of us are going to be retired for a very long time. And we need to keep up with that inflation rate.
Steve, I tell you what, these folks at the Fed Reserve, they're on my nerves. I need them to start getting to work. What are they doing here, right? It turns out they're going to make another decision on whether or not to cut interest rates at the end of this month. But market strategist Drew Mattis tells CNBC that he's not holding his breath. I got to say, I agree with Drew. Let's listen to this.
The Fed really can't cut until they see solid evidence of weakening. And that means the unemployment rate needs to move higher. Without the unemployment rate moving higher, Powell's just kind of stuck because inflation is still a little too high. And the absolute worst thing the Fed could do is cut the Fed funds rate and have the 10-year yield move.
All right, so let's break this down a little bit. When interest rates are higher, rates for things like annuities, they generally follow suit there, which you can capitalize on that opportunity. So for people trying to time the annuity market, Steve, what's your message here about, the cost of waiting versus the benefit of just locking this in?
First, I will agree with Drew. The Federal Reserve is a tough position right now. Just tough. I mean, the uncertainty that we feel as just individual people, are interest rates going up, interest rates going down? Are the tariffs going to go up? The tariffs going to go down? One day it's this, one day it's that. Uncertainty usually causes people to what I call sit on your hands. And sit on your hands sometimes could be the worst decision that you could possibly make. And then you ask the question when we start to look at guaranteed income. I get to do the analysis for people around should I take my lump sum or should I take my pension? Well, a lot of people got upset when the interest rates rose and that lump sum they thought they were going to be getting from the company shrank. They're just keeping my money. No, they're not. They're doing almost the exact same thing in a pension, is they're buying a stream of income. And when interest rates are higher, it's less expensive to buy a stream of income. So right now is one of the best times that you could do that. Why? Because while interest rates are higher, it takes less money to get that guaranteed income that you cannot outlive. Now, that guarantee does come from an insurance company. It goes down to there. The pension guaranteed by the company that you have. So that personally funded pension is very important to have. I look at that for one side of annuity because I got clients that absolutely love the idea of having guaranteed income. And then I got the other side. I want to be a little bit more risky with my portfolio, but I want principal protection for part of my money. I want part of my money that cannot go down due to market volatility. Well, I can use a fixed index annuity for that also. So what's that do? With interest rates being higher, the way that you get your interest, participation rates, caps, any of those things, they're higher when interest rates are higher. Why? The bonds that underlie them are getting paid more. When interest rates drop, those bond values drop also. So it's the idea around it of it is right now is a good time. If you want principal protection, we look at one side. If you're looking for guaranteed income, we look at another. I am not a big advocate of trying to find one product that does it both. It just doesn't usually work out real well. Give me the job and let's find the right tool for the job. If I want to hammer in a nail, the screwdriver will work, but a hammer works a whole lot better.
Thanks for listening to the Aul Financial Hour Podcast.
Insurance products are offered through the insurance business Aul Insurance Group, LLC, AIG. Aul Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Aul Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and Aul Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Aul Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Aul Financial Group, LLC.
This radio show is intended for information purposes only.